Let me invite Dr. Chandranath Amarasekara, Director of Economic Research, to commence his brief. Dr. Amarasekara, passing on to you, sir.
Thank you, Kushan. Let me set up my slides first. Thank you once again, Kushan, and let me start by welcoming all of you once again and thanking our Center for Banking Studies, IT and Communications Department for organizing today's webinar. As you are aware, the Central Bank published its 70th annual report recently, and it is a statutory obligation that we submit to the Honorable Minister of Finance and publish the annual report by the end of April each year. And the annual report must incorporate three key sets of information. First, on the condition of the central bank, then a review of the policies and measures adopted by the board during the year, and finally, an analysis of the economic and financial circumstances which prompted those policies and measures. With this information, the annual report is in fact a report on the state of the economy. And we also try to provide projections and expectations for the medium term through the annual report as well. Let me start with by giving a summary of Sri Lanka's economic performance during the year 2019. And in terms of economic growth, the economy recorded a disappointing growth rate of 2.3% during the year, following growth rates of 3.6% in 2017 and 3.3% in 2018. The key reason for persistent low growth was lack of investor confidence and policy and political uncertainties. And growth in 2019 was also hampered by the Easter Sunday attacks, which dampened business confidence and economic activity further. Another key contributory factor for low growth in 2019 was the measures taken to stabilize the macroeconomy. These measures, particularly those aimed at reducing the pressure on the trade balance, the external current account balance, and the balance of payments, helped achieve a desirable external sector outcome during the year. Accordingly, the trade deficit declined sharply, the current account deficit contracted in spite of the decline in earnings from tourism. The balance of payments recorded an overall surplus, and the year-end exchange rate appreciated for the first time since 2010. Low levels of economic activity and measures to curtail imports resulted in subdued performance in the fiscal sector. The fiscal sector performance further worsened as a near-term impact of the fiscal measures introduced to revive economic activity. And this resulted in a higher budget deficit, and the central government debt increased further in 2019. And with low levels of aggregate demand, inflationary pressures remained muted in spite of occasional supply-side disruptions to food prices. In this environment of muted inflation and diminished pressures in the external sector, the central bank switched to an accommodative monetary policy stance to support economic activity. This stance was further strengthened by regulatory measures to speed up monetary policy transmission through the financial sector. Weak economic conditions also affected the health of the financial sector to a certain extent, but the banking sector in particular remained resilient. At the beginning of the year 2020, the Sri Lankan economy showed some signs of recovery in response to the policy measures taken and improving business confidence. However, the COVID-19 pandemic and the lockdown measures resulted in severe disruptions to economic activity. This has made macroeconomic management in 2020 extremely difficult, particularly in the face of limited fiscal space to address the effects of the pandemic. The government's efforts have been supported by the central bank and the financial sector using the available spaces in the monetary and financial sector spheres. We expect the setback from the pandemic to be temporary, although there will be rethinking of economic policies and strategies in the government as well as the private sector. But in any case, we expect that from 2021, with appropriate reforms, the country will revert to a sustained high growth path. As I mentioned earlier, real GDP growth rate decelerated further to 2.3% in 2019. All major sectors of the economy recorded positive but modest growth rates during the year. Affected by extreme weather conditions, Agriculture-related activities, with a share of 7% of GDP, grew at 0.6% in 2019, and this followed a growth of 6.5% in the previous year. With the revival in construction, industry-related activities, which had a share of 26.4% of GDP, grew at a faster pace of 2.7% compared to 1.2% in the previous year. Services activities, which account for 57.4% of GDP, slowed to 2.3% compared to a growth of 4.6% in the previous year. Services activities were the worst hit sector from the East Sunday attacks and the curtailment of imports. And looking at per capita GDP, although the World Bank classified Sri Lanka as an upper middle income economy during the year based on its past performance, there was a notable drop in per capita GDP to US dollars 3,852 in 2019 from US dollars 4,079 in 2018. Subdued economic growth, coupled with the sharp depreciation of the rupee towards the end of 2018, that resulted in a substantially depreciated average exchange rate in 2019, caused the decline in per capita GDP during the year. This also affected the overall value of GDP in US dollar terms, which contracted to US dollars 84 billion in 2019 compared to US dollars 88.4 billion in the previous year. As a result of subdued economic activity, the unemployment rate also increased to 4.8% in 2019 from 4.4% in 2018. Youth, educated and female unemployment, as well as low labor force participation rates, remained concerns during 2019 as well. In terms of employment status, public sector employees accounted for 14.9% of all employed, whereas own account workers and unpaid family workers added up to 39.5%. According to a survey done by the Department of Census and Statistics in 2018, Sri Lanka's informal sector employment has been estimated at 59%, whereas informal employment, including casual workers in the formal sector, amounts to about 68%. With regard to consumer prices, inflation remained low during 2019, but with supply-side disruptions towards the end of the year. National CPI-based inflation, which gives a higher weight to the food basket, surpassed Colombo CPI-based inflation in the last few months of 2019. Co-inflation, which removes volatile food and then energy and transport items from headline inflation, remained in mid-single digits. Broadly speaking, the absence of demand pressures was observed in the movements in inflation during the year 2019. Earnings from exports grew by 0.4% to US dollars 11.9 billion during the year. Exports of textiles and garments, which account for 47% of our exports, increased by 5.2%. The United States remained the main buyer and purchased 26% of our exports, followed by the UK, India, and the European Union nations. These statistics yet again highlight the lack of diversification of our export products and destinations. Expenditure on imports declined substantially by 10.3% to US dollars 19.9 billion in 2019 from US dollars 22.2 billion in the previous year. A large part of this reduction was due to the policy-induced reductions in personal vehicle and gold imports. Although fuel imports also declined, Sri Lanka spent US dollars 3.9 billion on fuel imports during the year. And China and India continue to dominate as main import origins of Sri Lanka. With these movements, the trade deficit contracted by US dollars 2.3 billion during the year, which was almost equal to the reduction in import expenditure. Trade deficit as a percentage of GDP improved to 9.5% in 2019 from 11.7% in the previous year. The tourism sector was the most affected sector from the Easter Sunday attacks. And during the month of May 2019, there was a 71% year-on-year decline in tourist arrivals. However, there was a faster than expected recovery, and overall tourist arrivals declined only by 18% during the year. Sri Lanka earned US dollars 3.6 billion from tourism in 2019 compared to US dollars 4.4 billion in the previous year. And it is unfortunate that tourism sector has faced a further setback with the COVID-19 pandemic, even before it fully recovered from the Easter Sunday impact. With the decline in earnings from tourism, net inflows to the services account also moderated. And there was a decline in workers' remittances as well by 4.3% to US dollars 6.7 billion, impacted by the geopolitical developments in the Middle East. Supported by the contraction in the trade deficit, the external current account also showed a notable improvement. In fact, there was a surplus in the current account in the first quarter. The current account deficit improved by 1 billion US dollars. And as a percentage of GDP, the current account deficit was 2.2% in 2019 compared to 3.2% in the previous year. The financial account of the BOP saw increased inflows during the year. And most of these were, however, debt-related inflows led by the two issuances of the international sovereign bonds amounting to US dollars 4.4 billion. And foreign direct investment amounted to US dollars 1.2 billion during the year. And major outflows included the repayment of maturing ISBs amounting to US dollars 1.5 billion, and net outflows from the rupee-denominated government securities market amounted to US dollars 333 million. Compared to the deficit of US dollars 1.1 billion in 2018, the balance of payments recorded a surplus of US dollars 377 million in its overall balance. Gross official reserves increased from US dollars 6.9 billion at end 2018 to US dollars 7.6 billion at end 2019. This was sufficient to cover 4.6 months of imports. In the first 4 months of 2019, the rupee appreciated sharply, and in the aftermath of the Easter Sunday attacks, it experienced some pressure. Overall, the rupee appreciated by 0.6% during the year, following a sharp depreciation of 16.4% in the previous year. The central bank was able to purchase US dollars 387 million on a net basis from the domestic foreign exchange market during the year 2019. When you look at fiscal performance in 2019, we see that fiscal performance weakened in 2019 amidst the notable decline in government revenue and the rise in recurrent expenditure. The suboptimal outcome in fiscal operations in 2019 and the lack of fiscal space in the face of external shocks underscore the necessity of strengthening the fiscal consolidation process in the period ahead, supported by prudent expenditure rationalization and revenue enhancement measures once economic activity normalizes. Key fiscal balances deteriorated in 2019. The overall fiscal deficit increased to 6.8% of GDP in 2019 from 5.3% in the previous year. The current account deficit, which reflects dissaving of the government, expanded to 2.7% of GDP from 1.2% in 2018. The primary balance, which excludes interest payments from the overall deficit and reflects the discretionary component of fiscal policy, returned to deficit levels after recording a surplus for 2 years. The government initiated several rounds of fiscal easing measures during 2019 and in the first few months of 2020. These included measures taken in response to the Easter Sunday attacks, measures taken after the presidential elections to address the persistent subpar economic growth, and measures initiated in response to the COVID-19 pandemic. The central government debt to GDP ratio increased to 86.8% of GDP by end 2019 from 83.7% at the end of the previous year. The shares of domestic and foreign debt as a percentage of GDP were recorded at 44.1% and 42.6% respectively. And in nominal terms, total outstanding central government debt stock increased by rupees 1 trillion during the year to rupees 13.03 trillion at end 2019. And this reflected the impact of higher net borrowings to finance the enlarged budget deficit. When you look at monetary policy, the central bank adopted an accommodative monetary policy stance in 2019, considering several factors. These included low inflation, the low inflation environment, persistently low economic growth, the sharp deceleration in the growth of credit and monetary aggregates, and the reduced pressure on the external sector as well. And relaxation of monetary policy continued into the year 2020, particularly with the aim of supporting economic activity affected by the COVID-19 pandemic and the lockdown. The policy interest rates were reduced by 100 basis points in 2019 and by a further 150 basis points thus far in 2020. These in addition to the 3.5 percentage point cumulative reduction in the statutory reserve ratio in 2018, 2019, and 2020. And the bank rate has also been reduced sharply in 2019. To induce a reduction in market lending rates, caps were introduced in 2019, first to bring down the cost of funds of banks through lower deposit rates, and then to bring down the prime lending rate and the overall lending rates. There was a notable reduction in interest rates in response, but there is a need to create a culture of single-digit nominal interest rates, particularly as Sri Lanka has experienced single-digit inflation for a continued period of over 11 years. Broad money growth decelerated from 13% at end 2018 to 7% by end 2019. The slow growth in broad money was a result of subdued credit growth to private and public sectors, although the growth of both domestic and foreign assets contributed positively to broad money growth. And credit extended to the private sector by commercial banks decelerated sharply to 4.3% by in 2019. And this was the lowest annual growth of private sector credit since 2009. Credit to all key sectors of the economy decelerated. However, with a gradual reduction in market lending rates and the return of business confidence, a pickup in credit disbursements was observed towards the end of 2019. With low levels of credit disbursements, the banking sector expanded at a slower pace. There was some increase in NPLs and profitability of the sector also declined. However, the banking system maintained capital and liquidity levels well above the regulatory minimum requirements, thereby remaining resilient. Performance of the licensed finance companies and specialized leasing companies sector deteriorated in 2019. This was with negative credit growth, declining profitability, and rising NPLs. However, the sector as a whole remained stable. As usual, in the annual report, we provide projections for a 5-year horizon for the benefit of various stakeholders. And the projections in the annual report in 2000 for this year were made based on information available up to early April, as usual. However, 2020 is an year where projections are extremely uncertain, as the pandemic has resulted in an extremely dynamic situation. If you look at the real sector projections, at the beginning of the year, with increased optimism and improved business confidence after the presidential elections, the country was gearing up to achieve above 5% economic growth in 2020. However, with the spread of the COVID-19 pandemic and the global economic recession projected for 2020, Sri Lanka's growth projection has also been revised downwards to 1.5% in 2020, before returning to a higher growth path thereafter. A V-shaped recovery is projected for Sri Lanka as well. There is a possibility for the economy to record a contraction in the second quarter of the year. However, with the removal of lockdowns and normalcy returning, domestic economic activity will drive growth in the second half of the year. We expect some recovery in global economic activity in the fourth quarter, and Sri Lanka will also benefit from the beginning of this global recovery in the fourth quarter. And with supportive policies and reforms, growth is projected to accelerate towards 7% over the medium term. As the COVID outbreak is more of a global issue than a domestic issue, uncertainties will be mostly reflected in the external sector. As you may have observed, the rupee, which depreciated against the US dollar close to 200 rupees before the traditional new year, has appreciated sharply and is now around 186 rupees per dollar. The central bank has been purchasing foreign exchange from the market in the past week or so as well. The drop in exports is projected in 2020, and in the first 4 months of the year, exports have amounted to around US dollars 2.9 billion, which is a drop of around 28% compared to the same period in 2019. Tourist arrivals in the first 4 months have declined by 44% compared to the previous year. And workers' remittances have declined by about 30% in April and amounted to around 2 billion US dollars in the first 4 months, which is a 9% year-on-year contraction. On the other hand, there will be a reduction in import expenditure as well. This is due to the reduced petroleum import bill, and we think that that will save us around US dollars 2 billion during this year. And also the reduced bill of intermediate goods imports with a decline in exports. And the curtailment of non-essential imports will also help us to reduce the import bill during the year. And with these, we expect the current account deficit to worsen in 2020 and improve thereafter. The medium-term fiscal path projects a weakening of the fiscal balances in 2020 before moving on to a consolidation path thereafter. A part of this weakening in 2020 is due to the payment of arrears from the previous year and recording of a part of debt already obtained in the previous year. Although revenue collection could decline in the near term with subdued activity and tax concessions, expenditure will also be low. Overall, a larger budget deficit is projected for 2020, and we expect fiscal consolidation to commence thereafter towards achieving the government's announced 4% budget deficit target in the medium term. The monetary sector is expected to provide adequate liquidity, and private sector credit is expected to be dispersed sufficiently to support the revival of economic activity. Within the flexible inflation targeting framework, inflation is projected to be maintained in a range of 4 to 6% in the medium term. However, supply side improvements are essential to reduce short-term fluctuations in inflation driven by domestic food price volatility. The envisaged medium-term macroeconomic path cannot be achieved automatically. There are numerous challenges to achieve this path, and these are also discussed in the annual report. Appropriate growth supportive reforms are required to be implemented to address long-standing structural issues and enhance domestic production, improve export orientation, attract foreign direct investment, facilitate innovation, improve factor productivity, establish a nationwide contributory pension and social security system, and improve policy buffers. These need to be addressed without further delay. And if I'm to quote our own annual report, these need to be addressed without further delay, enabling the Sri Lankan economy to take off on a sustainable footing, which would allow Sri Lankans to enjoy prosperity that has eluded them in the past. The annual report contains 14 box articles on topical issues as well. These cover several areas of general interest, such as COVID-19 and Sri Lanka, the need and the readiness for economic takeoff, emergence of gig economy, energy requirements for sustainable growth, education reforms to break free from the middle income trap, the importance of effective management of government expenditure, etc. I would like to invite all of you to go through this large collection of analytical material in these articles, as well as the overall content of the annual report. And this has been painstakingly compiled by the staff of the central bank. As you know, the annual report is freely available online in English, Sinhala, and Tamil languages, and printed copies are available to purchase as well. Before concluding my presentation, I must thank the numerous parties that helped us to prepare this annual report under lockdown conditions. I express my gratitude to all external stakeholders, including numerous public and private sector organizations who provided the various types of inputs for the annual report. And this enabled us to analyze the true state of the economy and present it to policymakers and the general public. And within the central bank, I would like to thank the Governor, Deshamanya Professor W.D. Lakshman, former Governor Dr. Indrajit Kumaraswamy, members of the Monetary Board, Senior Deputy Governor, Deputy Governors and Assistant Governors, directors and staff of all departments for necessary technical inputs and various other kinds of support to finalize the annual report on time. I would like to thank my colleagues in the Economic Research Department for working tirelessly day and night, enabling the completion of the annual report on time. And I also must thank their families for the great tolerance shown during this hectic period amidst the lockdown. Thank you all for attending this webinar, and let me hand over the floor back to Kushan. Thank you.
Thank you very much, Dr. Amrasekar, for that informative synopsis, from which we were able to grab a good understanding on the developments took place in the year 2019, as well as the way forward. Now we can move towards a panel discussion where you will be able to direct your questions, as I mentioned earlier, in writing through Zoom as well as Facebook page. This panel discussion will be moderated by Dr. PKG Harishchandra, Additional Director of Economic Research of Central Bank. So now I cordially invite Dr. Harishchandra to take our session. Passing on to you, sir.
Thank you very much, Kushan, and thank you, Dr. Amrasekar, the Director of Economic Research, for giving the viewers the synopsis of the Central Bank Annual Report 2019. So it seems that your presentation has stimulated many viewers to ask a lot of questions. We can see a large number of viewers joining in this webinar today through Zoom as well as on Facebook Live. So we have already got a few questions through email as well, following the announcement of this webinar. So before we open the forum for question and answers, may I invite the chair of the panel, Governor of the Central Bank, to give some opening remarks till we get ready for the questions and answers. Over to you, sir.
Thank you very much. Congratulations to Dr. Amrasekar and his team, who have done an extremely difficult task on time, preparing the annual report and all its contents. Although we have been talking mainly about economic growth and also to some extent other subject areas like inflation, our title has stability, sustainability, and shared prosperity. When you have the sharing of prosperity in our objectives, there is always likely to be some trade-off. And I think in the recent Sri Lankan history, although we wanted to achieve very high rates of growth, like the ones which countries like Japan or Korea or China achieved over a period of 10 years, kind of 10% like growth. The Sri Lankan growth performance has always been lower than that. There were, to my recollection, there were only 3 years in the last 70 odd years in which we got a growth rate of even something like 8%. According to the central bank's own numbers, which are summarized at the back of the present report. The 3 years in which we got something like 8% included in 1968, 1978, and more than 3 years really, 2010, and a couple of years later than 2010. Every time we got any growth rate as high as that, following 4 to 5 years or more, there has been a gradual decline in the rate of growth. Start with 8%, and then after 5-6 years, we reach whatever is normal for Sri Lanka. So personally, in Sri Lanka, with its social democratic policies, sharing policies, if we manage to achieve 6 to 7% for a continued period of time, we ought to be, I think, happy. Now, in the Asian region, particularly in our neighboring countries, last year, growth performance has been better than Sri Lanka's. Bangladesh achieved 7.9% according to the World Development Report. This is 2018 number. India 6.8%, Nepal 6.7%, even Pakistan 5.8%. And if we go a little further away from Sri Lanka, Vietnam 7.1%, and nearer to us 6.9% in Maldives. Overall, South Asia was 6.7%. So naturally, we have been compelled to say our growth performance has been disappointing. In sometimes even this word dismal was used, I think, in this report in 2019. I think we are presently going through a very challenging, very difficult time. During this year, at least the numbers which are indicated about possible growth rates are not very good. The international publications, international agencies predict very low, in fact, even negative growth rates for this year. But I have confidence in the system and also impact of the policies that are being taken and also impacts on after the gradual waning away of the impacts of the coronavirus impact. There will be greater confidence entering into the system, and I am sure there will be positive growth performance in the year, contrary to what has been predicted by the IMF and similar organizations. Anyway, within the growth path allowed by our dominant social philosophies and policy paradigms. We have gone through a difficult period. We are sometimes hampered by internal war conditions or internal strong conflict conditions. Last year also we had a similar event. So having gone through this period, I think we should expect towards the waning of the influence of coronavirus. Hopefully in 2-3 months' time, we will be getting back into whatever is normal or whatever is new normal, as some people are talking about. And hopefully, let's hope that we will achieve greater success in not only growth, but also sharing of the growth results. I will hand over the mic to the moderator. Later on, I can come in if there is time and if there is any interesting question to be addressed. Thank you very much.
Thank you very much, sir, for very insightful opening remarks. So we've been getting a lot of questions, and some of them are like very similar. So we can perhaps combine these questions and ask from the panel. So the first question to the panel is, again, a widely discussed topic in the media these days about the debt servicing requirement of Sri Lanka this year and how we are going to finance those service requirements. So the question refers to as what is the actual situation of debt servicing of Sri Lanka, and how confident is the central bank that the country will be able to maintain its unblemished track record regarding debt servicing by the government. So maybe our senior
Thank you
deputy
for the question. May I take up that?
Please.
I think that's an important and very timely question. So if you look at obviously debt service payments, external debt service payment for the year is about $4.8 billion for 2020. And we had about 7.5 billion reserves at the end of 2019 as well, already published in the annual report. Then there are some foreign currency denominated domestic debt as well. That is, take total is about $6 billion. Now the strategy that we adopted last year, especially knowing that this year is going to be an election year, especially for 6 months, we created buffers in terms of raising sufficient external financing and build up reserves up to 7.5 billion end of last year through 2 ISB issuances of $4.4 billion. As a result, the reserves we had at the beginning of the year was sufficient to finance at least comfortably about up to 10 months of 2020, including the maturity of ISBs. And obviously, plan was to go to the market and raise another commercial financing to roll over or meet debt service obligations for 2020. But as a result of this COVID-19, government had to change and had to change the external financing strategy. Now, so far, first 4 months, we have been able to meet all debt service obligations on time without any delay, without any restructuring. And still, we maintaining end of April, we have maintained 7.2 billion reserves compared to 7.6 billion. Even after settling $1.6 billion of external debt service payments, we are still maintaining was $7.2 billion of reserves at end April. So going forward, obviously, there are some more payments. It's about $3.3 billion to be paid
in the balance period. And government is in the process of negotiating or discussing alternative external financing plans going forward. Especially given the global capital market situations where the lot of emerging and frontier market countries would not have access to capital markets in the near future. These were the official creditors like the IMF, like the World Bank, ADB, AIIB, European, some of the official creditors. Government is negotiating to have some facilities, especially in the face of COVID-19 issues that we are facing right now. In addition, from the central bank side, we have been discussing with especially Reserve Bank of India for a short term of facility, which will give us pretty soon about $400 million. Then we will build up our resource back to the levels that we had at the end of the year. And with that, I think with all these plans, we are very confident that we will be able to meet all these debt service obligations in the balance period. And once the situation improves towards the end of the year or early next year, we will have access to capital markets, and then we will be able to raise not only the official credit lines and as well as other concessional financing, but as well as commercial financing for us to meet the service obligations going forward. This is one of the reasons, obviously, this is one of the concerns raised by rating agencies, some of the investors. This is why we issued a statement last week committing or giving strong commitment on behalf of the government and the central bank that we will be meeting all external service obligations on time without any default, and we are committed to maintain our unblemished record of non-default of debt obligations, and we will maintain that even going forward. So I think we can give the assurance on behalf of the government and its guard as well as the central bank that we have plans and we will be able to manage the situation going forward. Thank you.
Thank you, Senior Deputy Governor Dr. Veerasinghe. The other question is on financial system stability. So it appears that the financial sector is milked to the maximum to provide facilities to the customers affected by the COVID outbreak. So the question is this is a sustainable model? And aren't there any concerns or risks to financial system stability?
May I take that question?
Please, Deputy Governor.
Yeah, thank you very much. First, I would like to highlight that the banking sector is always closely working with the customers. So therefore, even at this time, it is the utmost duty of the banking system to protect their own customers. Having said that, let me highlight a few things about the banking sector in Sri Lanka and its strength. During the year 2019, Sri Lankan banking sector had done quite well. With regard to the asset growth, we have seen 6.7% growth. And also the loans and advances grew by 5.6. Importantly, the investment had grown by 12.2. Also the deposit growth had shown 7.9. So therefore, when we look at these numbers, we can clearly see that the banking sector in Sri Lanka is resilient and stable. Also the total interest income, that also grew in 2019 by 10%. And when we talk about the profit number, we have seen a modest growth, but absolute numbers are high. With all those things, we have seen another remarkable factor in our banking system with regard to the compliance with the international standard. As far back as 2012, Sri Lanka had complied with all the Basel requirements, at that time Basel II, and also International Accounting Standard 32. Thereafter, by 2018, we have again moved forward to comply with the Basel III and also the much rigorous Sri Lanka Financial Reporting Standard 9. So that required more stringent measures, especially banks to have more futuristic standard and very rigorous loss risk management calculations. And also the risk management sector that had worked remarkably well in Sri Lanka. In addition to that, Sri Lankan banking sector had so many other buffers to face with this difficult situation, especially a regulator had given too many relaxations. I must say that the systematically important banks and the non-systematically important banks were able to draw down their capital conservation buffers by 150 basis points. And also the relaxation with regard to the classification of non-performing loans. Another advantage given to the banking sector to absorb these difficult situation in this difficult situation to absorb the difficult conditions. And again, banking sector were given so many other requirement facilities like permitting to convert recovery of foreign currency loans in Sri Lankan rupees. So likewise, we have given, the regulator had given too many leeway, and also the reducing minimum liquid asset requirement. Again, that created extra liquidity to the banking system. Likewise, the interest rate, as we heard from the direct economic research, interest rate had to substantially reduce in Sri Lanka. So all those things had helped the banking system even to borrow finance at a low rate. So therefore, I don't think that the banking sector had affected badly with those things. So we have provided the required nutrition to have more milk, and by having that situation, not to face with some stress situation. So therefore, I think still our banking system is capable to handle these stress situations.
Thank you, Deputy Governor, for that answer. And the next question is on money printing and inflation. So the reviewer asked, the holding of central bank in central government securities have risen from 69 billion to 307 billion from February to May. So what he's asking is this going to be inflationary in the coming period? And what's your view on that, and what will be the impact of this move in the economy in particular?
Thank you for that question. Let me take this question. It's an important one that a lot of people are asking. I think first of all, you have to understand the role of central bank, and especially at a time of unusual circumstances or exceptional circumstances that we are facing right now. The prime responsibility of any central bank, not only Central Bank of Sri Lanka, any central bank around the world, as we have seen already, is to provide sufficient liquidity for the banking sector and also sufficient liquidity for the people, public, to be enabled for them to have transactions and have sufficient currency circulation or sufficient cash in their hand, especially during the lockdown periods. I think it is the Central Bank of Sri Lanka, again, is a prime responsibility, especially given the debt moratoriums. And banks are facing liquidity issues. And also people would like to hold more currency, cash in hand because of the lockdown situation. Our responsibility, prime responsibility at this point is to provide sufficient liquidity, as I mentioned earlier. There are several ways that we can provide the sufficient liquidity. First one is by buying foreign currency and issuing rupees to the market. Second, by buying treasury bills and bonds from the secondary market or from the primary market to central bank accounts and provide rupee liquidity into the banking system and to the hands of the public. So what we have done so far, since the liquidity issues in the bank market as a result of this COVID-19 issue, we have been buying government securities. That is because our reserve levels have been going down small amount, as I mentioned earlier, from 7.5 5 billion to 7.2 billion, which is absorption of liquidity from the market, then we have to provide that liquidity as well as additional liquidity to have a sufficient liquidity in the banking sector. So the instrument that we are used by buying treasury bills and bonds from both primary market and the secondary market. As a result, the numbers that you have mentioned is correct. And as a result, there has been still, there has been sufficient liquidity in the market. This is what in simple terms people call printing money by the central bank, and what we are providing liquidity into the banks and to the public. And if we did not do that, imagine the situation that we are going to face is basically people would not have currency for their day-to-day transactions in their hands, and banks would not have sufficient liquidity to smoothen out the kind of a situation and provide credit and necessary financing for the businesses that has been affected. So as we have done that. It's not only Sri Lanka. If you look at all over the world, I think if you compare the Central Bank of Sri Lanka's liquidity provision compared to other countries in the region, frontier markets, emerging markets, and advanced economies, trillions, their balance sheets have expanded 10% of GDP, sometimes 15% of GDP in advanced countries. So this is all over the world, and this is how central banks business are conducted, and they are primary reserve. That is why we also have been done our job as a responsible central bank, and obviously concerned that some places whether this should lead to a high inflation. And this is where I think our monetary stance very clearly we have announced that growth is very low. We are countries growing well below the potential, and especially this COVID-19 situation, aggregate demand is very low. There's no excess demand in the market or in the economy. Seeing going forward, inflation soon after end of the year, we had seen some supply side impact, and inflation went up. Even now, inflation is coming down, and our indicator, our expectation, inflation is very well anchored. We will be able to maintain inflation between our target range of 4 to 6%, and still growth is going to be much lower than our potential growth. And therefore, as a result of providing more liquidity into the market, and which is not excessive compared to the overall monetary expansion, which is going to be, say, monetary expansion, if that's going to be 13%, 15%, still we are within those ranges. And it's not going to be excessive. We are not going to see any adverse impacts of providing central bank liquidity to the markets, and we are not going to see any adverse impact in terms of overheating the economy or in terms of high inflation. This is where I think we have done the right thing. I think it's important for general public to understand the perception of money printing versus central bank's duty to provide liquidity in this kind of situation, and how we are going to manage that situation going forward without destabilizing overall macro. And another part I want to mention is that if we are providing more excess liquidity in the market, then you're going to see is in terms of pressure on the currency. But we are seeing so far this year, our interventions, that's other question I saw somewhere, someone has raised the question is that whether we have been defending the currency and as a result of printing money. That is also not the case here. And we have been able to maintain sufficient level of resource while allowing currency to be flexible, and also now currency is appreciating. And our interventions has been very minimal, that I can say responsibly. Intervention has been minimal, and also now there's a pressure for the currency to appreciate further. So the question is that there's no pressure on the balance of payment side because it helped by certain controls on imports as well, and there's no pressure on the overheating the economy. There's no pressure on the inflation, and in this kind of environment, it's our duty to provide sufficient liquidity for the economy. Let me stop there. Thank you.
Thank you, Senior Deputy Governor, and the time has passed very quickly. Actually, now almost 28 minutes is passed in the Q&A session. Maybe the last question to the panel is, with a lot of questions we can see from most viewers on the impact of COVID on the Sri Lankan economy this year. on tourism, on remittances, on the overall employment, and etc. So the common question is, how confident are we in projecting 1.5% economic growth for this year? And how realistic is that? That's the sort of a common question, maybe the last question to the panel.
Mr. Wijayasekara, would you like to answer, or can I?
I think Chandranath can answer probably. We are
As I explained earlier, I mean, at the beginning of the year, our expectation was anyway that growth in 2020 would be about 4% or plus 4%. That was also based on the understanding that the elections would be held in the first half. The budget would be presented towards the end of the first half, and most of the economic activity would happen in the second half of the year. But obviously, there is a global concern with the COVID pandemic, and the growth is going to be much lower. But and our expectation is that compared to that 4.4 to 4.5% growth that we projected at the beginning of the year, growth would be 3 percentage points less, about 1.5% in 2020. But I think what the IMF and the other external agencies have done is that they've taken the 2.3% growth in 2019 as a baseline and taken computed a cut onto that growth rate. But what we have to understand is that in 2019, Sri Lanka's growth was affected mainly because of two domestic factors. One was the Easter Sunday attacks, and the second one was the political and policy uncertainties that were there in 2019. So compared to that, we don't think that 2019 should be taken as a good base to project 2020 growth. At the same time, what we have been always arguing that Sri Lanka was less integrated with the global economy. So if we take that argument as correct, and we have also seen that domestic economic activity, domestic consumption, domestic investment, those have been driving domestic Sri Lanka's economic growth in the past as well. So when you look at all these, what we see is that there can only be, I mean, if at all, there can only be a contraction in the second quarter of 2020, because the lockdown was limited for just one half of March, the second half of March, during the month of April and the beginning of May. So lockdown was limited to 2 months. And because of that, we think that there will be a revival of domestic economic activity after the elections and after the budget. And that will help Sri Lanka to achieve a positive growth, definitely, and a positive growth of about 1.5% in 2020.
Thank you, Dr. Amarsekara. So with that, unfortunately, we have come to the end of this webinar today. And we see a lot of interest and a lot of questions from our viewers, but the time limits the sort of Q&A session. And so finally, let me thank our panel for sharing very valuable insights today. The Governor Deshamani, Professor Abdul Lakshman, Senior Deputy Governor Dr. Nandalal Veerasinghe, Deputy Governors Mr. S. Karunaratne, Mr. Mahinda Siruwadana, and Assistant Governor Mr. Rohan Wijayasekara, and the Director of Economic Research Dr. Chandranath Amarsekara. So let me also thank our viewers who tune in from various places, including overseas. So the questions raised by our viewers help the webinar to be more productive and insightful. So with that, let me end this webinar today and have a pleasant evening. Thank you.
Thank you.